Hello, Warriors. Dale Pinker here at TradeGate Hub, and we're going to take a look under the hood of the car and beneath the surface of the market with Michael Kramer today. Michael, great to have you here at TradeGate Hub. You and I have spoken once before, and I know that you look at things beneath the surface of the market. Just looking at a candle doesn't tell you what's happening inside of it. So welcome.
Thank
Glad
you.
to have you with us. What a great day to have you too, Michael. But before we get to the markets, why don't you just share with our viewers that you were more interested in the markets in high school than getting your driver's license and chasing women. I mean, girls. I mean, girls.
Uh, yeah, I mean, it's been like a fascination of mine for a really long time. And, it just started with, some curiosity and having some, talks with my dad at dinner or in long car rides about stocks and things. And he wasn't in the market, but I mean, he was an investor, but he wasn't professional. And, understanding and knowing that, he had owned a couple of stocks that were for me at some point later in my life. I started following them and I got really like kind of excited watching, especially like I'm talking 1994, 1995. I mean, when the markets were really just starting to really come alive again,
Yeah.
uh, after that 1990, 91, 92 period. And, I would watch on CNBC the ticker tape, the old ticker tapes. They would
Yeah.
go by, and every once in a while you catch like a glimpse of like IBM or something or GE. And, and I just started following it regularly. And it was just so exciting. And the fun of trying to predict what was going to happen next was just something that I had never really seen before. And, when I started doing it, as soon as I was legal and able to take custody, I took over my account, and at 18, traded all through college. I mean, not traded, but not where you're day trading, but
Right.
trading like you're buying a stock like Cisco, and then at the same time maybe you're selling something else, or buying something and owning it for a couple of months and selling it. I remember I used to trade like Tel Labs or Nortel. I mean, these names are long gone, but
Yeah.
Sun Microsystem, those types of things. And I would sit at the lunch table with my friends and we would talk about, our calling our brokers and placing trades and stuff. And it was really a lot of fun back then. And
It was a lot more fun for brokers too. They actually earned a living.
yes,
Do
I
you
remember
pay
when
you
you used to
pay
call, and it was,
commissions?
yeah, you pay like $100 a trade or something, or they
Yeah.
be like, oh, you got this one for free. And the meanwhile, they, sold it out of their discretionary, their prop
Yeah.
book or something. And but yeah, I mean, it was a lot of fun. And so I just really took a liking to it. And I started interning when I was 18, 19 that summer. And just never really looked back. I never really had another thought of anything else I wanted to do in my life. And I actually, when I was turned about 35, before I went out and started working for myself after a long career on buy side trading desk, I tried to think about other things I could do. And there was just nothing else I could find that kind of kept me as interested as this. And so this is where I am, and this is probably where I'll be forever.
Yeah, it's great when you finally make peace with it because it's Hotel California. You could check out, but you could never leave. Want to hear a
Correct.
funny story in my early 20s when I was trying to make it as a commodity broker. I had to take a job as a car salesman. Okay, so
Right.
I was the worst car salesman because every time I'd go on a test drive with someone, I would ask them if they were paying attention to what was happening in the gold market. So I was, instead of selling the car, I was soliciting an account. So yeah, I know how it could get in your blood, and
Right.
definitely it's the most fascinating jigsaw puzzle, financial Disneyland. So let's talk about today. You have a rep for being bearish for a while, Michael. You want to address that?
I do. And unfortunately for me, it's because no one knew who I was, 3 years ago. But I'm just really sort of a data-driven, common sense investor. And yeah, I mean, I've been bearish on the market for some time, and I kind of like bit the bullet through part of 2020 and was like, yeah, the market could go higher because earnings are recovering. But I also remember the 1990s all too well. And so, when valuations really started getting up there, knowing that the Fed was going to have to probably at some point start pulling back on QE and in easy policy, I became really bearish on the market. And I have been for some time because I think that this inflation problem is a really big issue. I think that rates are probably still too low. I think that financial conditions need to tighten and they need to stay tight for a relatively long period of time.
I want to ask you, do you think that financial conditions tightened from the employment report we had a couple Fridays ago? Or was it only last Friday? No, it was the
So I'm
Friday
going to show
before.
you, I can answer you that question. And
Okay.
there is one financial condition index that I think Powell is specifically referring to because it goes with his exact sort of timeline, right? And this is the Goldman Sachs Financial Conditions Index, right? And
Okay.
what you see here is on December 13th or 14th was the time of the Fed meeting in December.
Yeah.
You see where we are, 99.7.
Right.
It tightened. So when the number rises, it's an indication of tightening. And when the number falls, it's an indication of easing. 99.7. And then where were we on February 1st? At that last meeting, we were somewhere. Was that the last meeting? Was right
There, yeah, right there.
right in here. So where are we? 99.67. So we were virtually in the same spot. You can see, I mean, you just draw a line, it's basically in the same spot. So he was like, yeah, they tightened a little, then they eased, and now you can see since the employment report, they have tightened a little bit. So if this is the financial conditions index he's referring to, then he is not incorrect.
Well, because a lot of people are saying the recent rally we've had from January, which was a face ripper.
Yes.
Were you surprised by the January effect this year being a bear?
Yes.
I know
And you
I
can
was.
see you are.
I was, I thought Apple had broken down under 125, so I had all kinds of lower targets for Apple before it negated the breakdown that I thought it would take the whole market with it.
Yeah, and I mean, you can see financial conditions from this peak at basically on December 28th did ease an awful lot.
A
And
lot.
it really wasn't until, but this financial condition index doesn't really do it justice in terms of how much they really ease. Because if you look at this one, this is the Chicago Fed one, which is, the one that I prefer. But clearly knowing now, I think that Powell uses the GS Financial Conditions Index. I have to pay more attention to that one. But this is the one that I specifically pay a lot of attention to. The black line is the National Financial Conditions Index.
Yeah.
The dotted black line is the adjusted National Financial Conditions Index. So just like a slight moderation in it. You can clearly see financial conditions tighten, markets come down, financial conditions ease, markets go up. And you can see there's just been a tremendous amount of easing. But despite all this easing, the market really hasn't done very much.
Yeah, we haven't gotten back to the August highs, which
no.
Yeah,
and if
go
you
ahead.
look at where we are right here with a negative 0.043, negative 0.043, we were somewhere in March, the index was trading at around, call it 4,300.
Yeah.
So, we haven't really gained back everything. And yes, the easing of financial conditions have certainly led to this January rally. And that's what's kind of also led back to this inflation that we're seeing again.
Right. Yeah, the 10-year note has gone up to about 390. It's about 40 bips. And you're showing the same thing, the breakout. And that, intraday, that line was tested, Michael. I know you
This
probably
one.
noticed. No, go back 2 days. Yeah, there, that candle.
Yeah.
Intraday, it tagged the line and came off. I think that was CPI.
Right. Okay.
So,
but you can see we're there now.
Yeah.
Right? And it almost
Right.
looks to me like as maybe it does to you too, like we're putting in a double bottom here.
Yeah, that
and
was a
very
200
close to,
day it held. Yeah.
yeah, and going very, and I think we could be going back to a 4% plus 10-year.
Okay, we're in agreement on that. We could even make new highs into the end of the year. So why has the market ignored, and it's not today? It's kind of like disintermediation. An extreme example was 1987 when, I don't know, you were an idea in your
I was
parents'
10.
mind.
I was
Huh?
10. I was 10.
Oh, well, you were more than an idea. You were a pain in the ass. So,
Yes, very much so.
all right. So in 87, we had massive disintermediation where yields were going up, the dollar was crashing, and it took a long time for October 87 to happen. Yields were going up way before the crash in October. So
Right.
you could have the market resist higher yields for a while. What's taking the market down today? Is there
Uh,
any,
well,
how are they rationalizing it today?
today, I mean, I think the idea that you have to understand where we were, a month ago, we were looking for inflation to be at 2% by June.
Okay.
This is the inflation swap curve. This is
Okay.
how the market was pricing in inflation. And this looked like, this was going to be the path. But all of a sudden, that's not the path anymore. And it's probably even now you can see we're 2.5% because it rolls forward. But this idea that we were going to be at 2% inflation by June, I think was just a fantasy.
Well, but in the market, we've been repricing rates for a week and a half, and the market, every time they tried to break it up until today, it would come back. It'd be like a beach ball. You
Well,
would push underwater, right?
that's like this, but that's driven by that, the creation of the CBOE with the every day is an option expiration party.
Yeah, I don't understand that. Do you? Tell our viewers what's going on there. Someone actually, I was interviewed on Real Vision, and she brought it up to me. I was frank. I said, I really don't know much about that. So tell
So
us
yeah,
what
I
it
mean,
is.
so I use Trade Alert, which is a CBOE product.
Yeah.
And if we just look at the most active volume yesterday,
Why are they doing that? Why is money doing this, Mike?
because they can make money.
Okay.
I mean,
All
it's
right.
really, it's
So
that
they just
simple.
buy 1 day calls
Look at
on a
all, this
dip.
is the most active contracts in the S&P 500. Where is it? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. The top 20 most active contracts, all for same day expiration.
Okay.
So, and then it's like, well, what are they doing? They're
Are they writing them or are they buying them?
well, so that's the interesting thing. I was looking at this last night because there was a story that Marco Kolanovich over at
Oh,
JP
yeah.
Morgan wrote. And
Yeah.
and so I took a little bit of a closer look at it. I'm trying to figure out which tab it was again. Put call most active.
And what's the term that they're using for this? These 1 day options?
Uh,
The
0 DTE. So,
zero
if we
DT.
just go to, the put call sentiment,
I
right?
used to have a DTN. It was a quote machine, but not a
Oh,
DT. You don't remember those, do you?
no.
The satellite dishes you give us like a flying saucer. Anyway, okay, go ahead.
I don't know. I'm having a hard time finding the screen right
Okay,
now. Just give me a second.
sure.
Option bucket report. So here you can see this is from yesterday, right? Let's just go back
Yeah.
to yesterday for a minute because there's not enough today. And we go into this option bucket report. So there was one out of the money puts, 1.5 million contracts traded. That was almost the entire put
Wow.
volume on the day.
Yeah.
So what are they doing? It looks to me, based off of the VIX just being crushed every day, people
Yeah.
are just selling out of the money puts for same day
Okay.
expiration. I don't, or they're buying
Why
calls.
aren't they selling? Well, with the VIX getting crushed every day, why aren't they selling calls?
They could be doing that too. I mean,
Okay.
with the VIX going down every day, it's telling us that they're either, buying calls or selling puts because implied volatility is coming down, right?
Well, we
So,
went from 17 to 22. We pulled back to 18 and now we're pushing 20. I think that people that are selling volatility are going to get crushed. They
well,
they
right,
have
and
they have recency bias, don't they? It didn't work all last year.
but it's worked for the last 15 years, right? And
But
so that's
yeah,
a hard habit to break.
yeah. Well, that's what I mean.
Yeah,
Selling volatility has worked. Yeah, before we had a decline in the market, and even
right,
with, if I had said a year and a half ago that we were going to have 25-30% drawdowns in the averages,
right.
wouldn't you have thought we would have had a 50 VIX at one point or something like that? So,
I mean,
no,
that's what I was looking for.
right.
In my 30 years or so of following the market, I had never seen a period of time where you didn't get the VIX to really spike. And so
Yeah.
I was tracking this analog for a really long time on Twitter. And
Okay.
this was 2022 versus 2008. And it was
Yeah.
working beautifully up until right here. And
Yeah.
then it just broke as I expected it would break at some point.
Yeah.
But I mean, 2008, you could see we clearly got a big,
Yeah.
VIX spike. And most of the time, you do get that big VIX spike. But what's happened though, because of zero DTE, I think, is that you're seeing basically more concentration in the shorter dated options. And so no one's going out and buying a monthly put anymore. They're buying the puts for the day of the event. And so what I've been focusing a lot more on recently is the 1 week 50 delta option, implied volatility. And basically the reason why I'm focusing on this is because I'm thinking of zero DTE as a gamma squeeze. And at some point for a call buyer, it becomes too expensive if volatility is rising. And so you can see that when implied volatility on these shorter dated options gets high, the market comes down because you can't afford, it doesn't pay to go out and buy a call anymore.
Okay. Got it. All right. So
And
great,
so,
great explanation
and I
there.
can show you one more. Let me just show you one more chart just to show you how much this is the zero DTE is influencing everything, right?
Yeah.
If we go one step further and let's go back to what was CPI on the 14th. So we'll go back to implied volatility curve of the 13th.
Yeah. Everyone was worried about it
So
until
look
it
at the
happened.
implied volatility curve,
Yeah.
and then it just falls off, right? And so
Right.
this
Yeah.
this melting and then after the event, all that implied volatility just vanishes, and that's why the market just doesn't, you see?
Yeah.
And there's your zero DTE.
Okay.
That's my theory.
Okay. Well, I think it's a pretty good explanation of what's going on. It was just brought to my attention, I don't know, about a week and a half, 2 weeks ago. You want to talk about how you follow the tip, and that's the inflation protected bonds,
Sure.
right?
So yeah, so basically, I run a subscription service on Seeking Alpha called Reading the Markets, and not everyone obviously has access to a Bloomberg terminal. And so I wanted to come up with an easy way to illustrate to them how you could follow the relationship between real yields and the Nasdaq. And the easiest way to do that is by overlaying the TIP ETF with the Nasdaq, with the QQQ ETF. And what you see when you adjust it for the dividends and everything, and you take it out, you can see that the relationship between the two goes back a really, really long time. I
Yeah.
mean, it certainly goes back to the end of 2018, but I would make an argument and say it goes back even further. And what you can see is that when the TIP ETF is rising, which is an indication of real yields falling and eventually going negative, that makes the valuation of growth stocks worth more when you do it in your discounted cash flow model. I'm not really a discounted cash flow type of guy because I think there are too many unknown variables that make all of this stuff too much bullshit and pie in the sky. But this is what drives, this is how people invest. And so when the tip goes higher, it's an indication of real yields going higher, lower. And when the tip ETF is going down, it's an indication of real yields going up. And so what we've had more recently is a massive divergence between the QQQs and the tip ETF. One's going to be right. And my bet is that the tip is going to be right, not the Qs, because the bond market typically knows. And when we illustrate this in another form, and we think about what the tip ETF represents, it represents basically the earnings yield of the Nasdaq 100 versus the 10-year tip rate, which is the real yield. You can see down here, the real 10-year rate was negative 1.2%, right, at the lows. Right. And you can also see that if you look more closely, the two tend to go together. So when the earnings yield of the Nasdaq is coming down, it's because the real yield is going down. And when the real yield is going up, the earnings yield of the Nasdaq is going up. But you can see more recently that spread has been contracting. Real yields have been starting to kind of come down. The earnings yield of the Nasdaq is going lower. And so what's happened is after, call it, a decade of basically trading with a spread between 3 3/4 to 4.25%, you can see the nearly straight line that this has been in. We're now at the most expensive Nasdaq basically in the past more than a decade, right? And so that's really that's what this divergence represents.
Okay.
How expensive the Nasdaq is getting relative to tips. So after being in a very, very well-defined trading channel, I mean, I think that's very easy to see, right? No matter how we kind of slice and dice it, there's very little oscillation between it.
Yeah.
This was March of 2018. I don't know how many people remember, but in March 2018, after that January 2018 drop, the Nasdaq actually went out to make a new high.
Yeah, that's when Paul flipped. That was another flip by Paul.
That was another point. But that was after Volmageddon 1. And this was when the Nasdaq. So we're more expensive right now than at really any other point except back here, which I would argue had some really weird things going on since it was just coming out of the 2008, 2009 financial crisis.
Yeah.
But other than that, I mean, we're talking about valuations that go back really far. And before that, you were talking about negative, where the earnings yield of the Nasdaq was above the 10-year tip. I'm sorry, the earnings yield of the Nasdaq was below the 10-year tip. And actually, there was a negative spread, which was in the bubble days, right? Okay. And so that's what this spread sort of represents right now. And it's even more profound when you switch it from the QQQ to the XLK. You see the spread is even wider.
Technology. Okay. Yeah.
So basically what this tells me is that I have to pay attention to what real yields are doing right now, because they're clearly diverging from the fundamentals of the Nasdaq, right? And when we look at this is something else. When I look at a chart of a 10-year real rate, unlike the 10-year nominal rate, it hasn't broken out yet. It's very close, though. You see the downtrend and the pennant formation.
It's
very
lagging.
Close to breaking out.
It's lagging the 10-year.
Right. And the reason why it's lagging the 10-year is because the market's pricing in higher inflation rates. The break-even inflation expectations have been rising. So as inflation expectations rise, the spread between nominal and real yields widens, which is basically what this represents. Okay. And so that's why the real yield is sort of lagging behind. But eventually, the higher 10-year nominal rates go, the higher 10-year real rates are going to go, and it's just a matter of time before everything just breaks again.
And we've had a dramatic shift in sentiment from late last year. There were hardly any bulls. No one wanted to buy this market. And the greedometer is not at extreme greed, but in the greed camp. It doesn't have to get to extreme. Just the fact that there are a lot of bulls out there that up until a week and a half ago, when the narrative changed, they may not have made the change yet, but that was a shift in the narrative from that employment report. And then the last two inflation numbers reinforce that employment report. You know what's interesting, Michael? Tell me this. So Powell's two main targets are housing and labor with using rates. How do you pop a bubble that's a shortage? We have a shortage of housing stock, and it's a secular story. It's been going on for a while, and we have a shortage of new labor coming into the market. So how are higher rates going to resolve the two things that the Fed is focused on? It almost seems like they're focusing on something they really cannot do much about with monetary policy unless they take us into a depression.
The problem is they're focusing on the wrong thing.
Right, but that's what they're
This
focused
is
on.
this is
And
their problem.
okay, all
The
right,
2 trillion excess dollars that's slushing around every day in reverse repo facility, which is basically just sitting in money market accounts.
yeah,
I mean, this is all Fed balance sheet. This is all from QE.
right. This
And
is the
so,
aftermath.
yeah, I mean, so basically there's just too much money in the system, and Powell can raise rates and he's trying to slow nominal GDP growth, and in hopes of that, tightening financial conditions to almost create what I want to say. When they say they're targeting financial conditions, we need to understand what they're really targeting. They
The
want
market,
the market. Exactly. They're targeting asset prices.
yeah,
Right. And so what they're trying to do is the reverse wealth effect. They're trying to make people feel poorer so they don't spend as much. And they're trying to do that by taking it away in assets.
right.
That's the
So,
best way I can equate it to.
okay, so you're on this, you're on the same side as the Fed here, Mike. You're not fighting the Fed. Do you have
No.
any kind of downside targets or roadmap for what you think the path could be for the S&Ps, especially for peaking out here and not being able to close above 4,200?
Well, I mean, the general rule of thumb that I've tried to follow, at least, historically speaking, is, I look at the P ratio of the S&P, and I try to think about where, what would be, a fair valuation where things start to make sense, where my downside could be limited, and I want to really get more, call it invested. Like right now, I'm long only. I have a really long-term time horizon. I hedge my portfolio by raising cash, right? And so like I just raised more cash just last week. I sold a position in Splunk that I owned. And when I look at the market, I try to think about where are valuations where the market has historically sort of, stopped falling, or where the market has kind of found some sort of bottom. And what I do is I look at the 1 year forward earnings estimates of the S&P 500. And then from there, I try to think about, what's a valuation that makes sense. And for me, a valuation that sort of starts making sense is somewhere in this 13 to 14 times earnings multiple, right?
Okay, all right.
And why I like that number is because I know historically the average is somewhere around 15 to 17 times. So if we use a 16 number, and what, it kind of also, if we kind of think about, the last time we were at this sort of 13 range, we had a 10-year that was trading right around, 4.25, and so basically I'm just trying to find something where we're trading at relative valuation to bonds. And for me, based on where yields are, I think right now that kind of is around 13 to 14 times. And, assuming that we're going to have, $222 in earnings in 23, and that's going to be, 223 times 13 is a 2,900 number. And if I want to go out a year, 242, that's probably even too high. So let's say a 230 times, which may even be high, you're still talking 3,000. So
Okay.
generally speaking, I'm sort of at an idea where I'm looking for a market that can get down into this 35, 3,400 range. And then I'm like, okay, I want to put some money to work at this level. And then if it goes up a little bit again, great. If it comes back down, then I want to just be buyer as the market continues to drop towards my target, and
Okay.
probably get more aggressive as it gets to my target, because at that point I can assess how much more downside risk there really is.
Okay.
That makes
Love it.
sense.
What it did make good clarity on it. I've got it. Our listeners have it. Our viewers have it. So the market's going to start having fair value for you around the 13 EPS, and uh, you're looking for the bottom of the range to start nibbling in the market, but looking for new lows for the move to get aggressive and back up the truck.
Right, because I mean, when was the last time the market traded at 18 times earnings for no growth?
Yeah.
In 2023. I mean, we're going to have zero growth this year. In fact, I think the growth may even be negative at this point. And you want to pay 18 times earnings for that? I mean,
Yeah.
that is not, that you've been around forever too. That's
Don't rub it
insane.
in. Don't rub it
What?
in, buddy.
But that's
Uh,
but that's insane though.
I'm like the Sphinx. Anyway, Michael, great. Really appreciate you sharing your insights with us today. And I'm sure that when people see this or they're watching now, they'd want to reach out to you and keep in touch with your work. Because most of us are pretty, technical. I see you have some nice looking charts and lines, but you really dig deep on the fundamentals. You're a thinker.
Yes, I
So,
try to at least.
all right. So, best way for people to reach out to you, would it be on Twitter at Michael Mott CM?
Yeah, that's a great avenue. And then also you can, find a lot of my writing on websites like Seeking Alpha. I publish under Ma Capital, and I also have stuff on my own website called macapitalmanagement.com. And then I also publish once a week on investing.com. So I'm
Okay.
around.
All
I
right.
also have my own YouTube channel.
Oh, okay. All right.
So I
So,
do once a week video there.
all right. Well, uh, lots of ways to keep in touch and be aware of Michael's insights. And I believe that we only have two eyes, and Michael has like about eight. So, he's watching everything time is my most precious currency. So
Well,
when I could find people that can distill things that would take me hours to do on my own, I value that. So
thank you.
yeah, I learned from you today, Michael. Appreciate
Thank
it,
you. I
buddy.
hope it helped.
All right, my trading warrior brother, Michael Kramer. Hope you guys enjoyed it. Reach out to him on Twitter at Michael Mott CM and check out his videos. And I'm with you, Michael. I'm looking for 48 VIX this year.
Well, we may get one, hopefully. I mean,
I'm long June 25 calls. So we'll see what happens.
I really just wish this would get over with
All
already.
right. Yeah, let's have the cleanse. Do you know that the month February, its Latin root is to purify and to cleanse. So we've had some cleanses going on, right? Long precious metal bulls, weak hands,
Yep.
miners getting hammered, bears getting squeezed. So we've been purifying these markets and setting up for, I think, very good buys in the metals. Do you think this rally in the dollar is just a counter trend
No, I
move?
think this is a real deal.
The dollar's going to go to 120?
I think it's going to probably I think we're probably going to get somewhere close to those old highs first, and then I'll worry about 120. So
Okay,
probably 114.
that's aggressive. All right, so there you go. That's what makes a market.
That's
Thank you,
right.
Michael. Good
Okay.
hunting. Good hunting, buddy.
You too. Talk to you soon.
All right, Michael Mott, everybody. No, it's Michael Kramer.
Michael
Michael
Kramer,
Mott.
Ma Capital.
Yeah, Mott. Why Mott?
It's just the part of the town that I live in, and that's what it's called, the Mott section.
Oh, okay.
I'm very creative.
All right, I'll just call myself San Diego. All
That's
right.
perfect.
All
San
right. Take
Diego
it easy,
Capital is good.
Michael.
Bye.
right, buddy.